Hello, everybody. Welcome. Welcome. Please let me know if the audio quality is good on YouTube and live chat. If you get a chance, let's get started right away. Tesla stock is down today. Tesla is actually flat now. It's recovered a little bit in the last few minutes at $394 per share. In the last 5 days, the stock has been flat, up and down between 380 and 420, but essentially flat around 300, mid 390s. In the last month, also flat. Lots of volatility, but not much of a price change in the last month, throughout the last month. Since the big bump that the stock got after the elections. After the elections on November 8th, from November 8th, the stock went up all the way up to 488, up about, it doubled, and then it come down about 20% after that. All right. NVIDIA stock is just below $140 per share, down about 0.5%. Same story in the last 5 days and the last month, and also for NVIDIA in the last 6 months, the stock has done pretty much nothing. 55 PE ratio, $3.4 trillion market cap, challenging Apple's $3.65 trillion. Let's look at if there's any news. Overall markets are flat. Russell 2000 down about 1%. Russell 2000, which is comprised majority companies that are not profitable and they have some refinancing risk. Russell 2000, I don't think is as popular as people thought it would be. As some people are recommending small cap stocks midway last year. Hasn't really performed for them too much, especially in a high rate environment, which is what we're heading into still. Rates higher, staying higher for longer. I don't see these small cap companies outperforming the Nvidias and Teslas of the world in the next few years here, unless if this high rate environment changes. The 10-year Treasury yield is now at 470, and earlier today that had gone up to, I believe, 472. Let's take a real quick look. 10-year yields earlier today, they went up to 473. That was the maximum. So, and they pulled back all the way down. Interesting. In the last couple of days, they've been kind of knocking on the door of 474.7% 10-year Treasury yield, which is very important for mortgage rates and auto loan rates. This morning, we got initial weekly claims, came in lower than expected at 200,000, which indicates that recession hasn't started yet. And ADP employment change as of December. So this is the employment week. ADP employment change was at 123,000, lower than expected. Still pretty low. 1 second. ADP employment change, which is sometimes seen as an indicator for Friday's employment report, came in at 122,000, lower than the expected 131,000, and lower than the prior month's 146,000. So in December, as we know, stocks surged after the election. And I thought that maybe the economic growth would pick up a little bit in December readings, or maybe January readings we're going to get next month. But so far, we don't really see evidence of that. We don't really see an evidence of economic growth following stock market prices. Mortgage applications index was down 4% overall and down 22% from prior. Prior was down 20%, but that was mostly refinancing index plunging. If I look at the purchase applications index, which is what I'm more interested in, purchase activity is down 15% year over year. And this is the least purchase mortgage application activity since 1995. And if you consider the fact that over the last 30 years, population has grown, tremendously in the U.S., and you still have this is a very depressed level of housing purchase activity since for the last 2 years now. Not even a dead cat bounce. But the mortgage rates have been, staying high, so you wouldn't expect a dead cat bounce. But I think this is the, I'm reading of some 8% mortgage rates for a 30-year fixed, and this could be the needle that pops the market for housing market. But we'll see. We'll see. I think if something like that happened, the Fed would respond with continued rate cuts. But it's hard to tell in January, December, January. These are seasonally low activity months for cars and houses, and so and lots of seasonal adjustment um, baked into these numbers. So we're not really going to see a clear picture of how the economy is doing until February, March. Probably like end of February, we're going to start getting a much better idea about Q1 economic growth. If I look at GDP now number, as of yesterday, the estimate was 2.7%. The next change is going to be tomorrow, Thursday. But tomorrow markets are closed. So it's really Friday's numbers. After Friday's numbers, we're going to get a better idea of Q4 GDP growth. Right now, all evidence points to the recession has not started as of end of the year. Oil prices have ticked up a little bit in recent weeks. Crude oil went up to $74 per barrel. Natural gas is also a little bit elevated due to the cold winter. U.S. dollar continues to strengthen. U.S. dollar has now 1.03. 1 euro. It's almost parity between the two currencies, but down from 1.12 at the end of Q3. So throughout Q4, US dollar has strengthened dramatically against other currencies, and we're going to hear about that a lot in earnings calls. To the extent that company generates its revenues or earnings in other countries, international markets, they're going to be impacted more when all of that revenue profit is translated back to US dollar for reporting purposes. Any questions, comments? Please request to speak. The FST tracker, I'm taking away 13.2.2.1 when I look at these things because there's not enough data from enough testers for that specific dot update. But if I look at the rest of the 13.3, so this would be 13.2, 13.2, 13.2.1, and 13.2.2. We have close to 6,000 miles with percentage drives with no critical disengagement being 96%. And this is in line with my expectation for V13. And this is despite the fact that only AI4 cars, hardware 4 cars have V13 still. I continue to have conversations with my friends who have Teslas and have purchased FSD, and they tell me that 99% of the time they're not using FSD. So these are people, an incremental use of FSD to them is zero cost, and they don't use it. So I don't see any evidence that FSD is driving purchase decisions at this time. I increased my Tesla short this morning, and I think about $400 per share is just not sustainable for Tesla. So anything above $400 per share is probably a good short as long as these interest rates remain where they are. Going back to FSD tracker, we're seeing 369 miles to critical disengagement and 174 city miles to critical disengagement and 75 miles to disengagement. This is very much in line with where I think FSD stands today. 96% of drives with no critical disengagement and 89% of drives with no disengagement at all. This is excluding testers less than 50 miles, which I don't know why it's not even there. But if I include the testers with less than 50 miles, then the metrics drop a bit more. 6,000 miles. But this doesn't make sense. So if I exclude testers with less than 50 miles, the miles, yeah, okay. So 6 to 100 miles, 96.5% drives, 338 miles to critical disengagement. So a couple hundred miles FSD can go without trying to kill you, basically. This needs to get to tens of thousands. So I don't think that's going to happen with hardware 3 or hardware 4, and maybe not even happen with hardware 5, but we'll see. AMD is down 5% today. Not sure if any news there. Let's see. Analyst cut ratings on AI concerns. Let's read that real quick. HSBC analysts delivered a blow to AMD on Wednesday, downgrading from buy to reduce and cutting its price target from $200 to $110, or nearly in half, due to this bearish sentiment. The stock plunged 5%. The downgrade stems from concerns over AMD's ability to compete effectively in the AI GPU market, especially against NVIDIA, which still dominates the sector. HSBC analysts frankly pointed to weak demand for AMD's MI3215 GPU and the possibility of delays in bringing a competitive rack solution to battle against NVIDIA's NVL platform. HSBC cut its fiscal 2025 AI GPU revenue forecast for AMD by half. Wow. Slashing its revenue expectations from 12.3 to 8.1 billion, well below a consensus of 9.5 billion. I have a small short position AMD, but it's not like it's very small. I'm just very negative on the entire sector or semiconductors. Despite the 24% correction in AMD's share price over the last 3 months, we still see downside risk steadily. Okay. AMD's roadmap includes MI350 GPU launch in late 2025, and HSBC doubts the company's AI offerings will match NVIDIA until the MI400 platform launch, which is expected before the end of 2025 or early 2026. Okay. That doesn't say much. They also know the concerns around AMD's slowed down non-AI data center revenue growth, client momentum, forecasting and client revenue will be up just 12% year over year in fiscal 2025 versus 44% growth in fiscal 2024. Okay. Any questions, comments? Please leave a comment, request to speak, or leave it in YouTube live chat. There's an article I want to read from T. Rowe Price about these yields. So let's do that while we have we don't have anyone on the speaker board. T. Rowe Price, 6% yield. T. Rowe raises prospect of 6% treasury yields on fiscal risk. Benchmark yields likely to rise on tax cuts, fiscal expansion. Foreign demand for treasuries is also falling, Hussein writes. Let's go to the source document here. This is a T. Rowe article on December 18th. The prospect of 10-year U.S. Treasury yields reaching 6% has resurfaced for the first time in over 2 decades. According to Arif Hussein, Chief Investment Officer for Fixed Income at T. Rowe Price. I mean, it just doesn't really get any better than this in terms of expertise. CIO of Fixed Income at T. Rowe. Hussein's forecast shared in a recent report highlights persistent U.S. fiscal challenges and inflationary pressures that may be exacerbated by the potential return of Trump-era policies, which is exactly what I've been saying in the space, is that Trump is coming into a completely different macroeconomic environment today versus 2016 with the same playbook. Hussein projects that the benchmark yield could first climb to 5% in the first quarter of 2025 before potentially pushing further to 6%. So he was right on the first part of the call. This again was made in December 18. and yields have been surging in the last couple of weeks here. And before potentially pushing further to 6%, a level not seen since 2000. Is a 6% 10-year treasury yield possible? Why not? But we can consider that when we move through 5%, he's saying we're pointing to opportunity for investors to position themselves during what he calls a political transition period. Fiscal deficits and inflationary risks. The basis for Hussein's prediction lies in two critical economic factors: persistent U.S. budget deficits and anticipated inflationary pressures from a second Trump administration. Key policy measures such as tax cuts, trade tariffs, and immigration restrictions could push prices higher and strain Washington's fiscal outlook. Quote, the transition period in U.S. politics is an opportunity to position for increasing longer-term treasury yields and a steeper yield curve. Interesting. I tried to go long treasury yields yesterday, treasuries, U.S. treasuries, just a little bit, dipping my toes in the water. But I mean, if he's right in his call for a 6% yield, then that position will lose money. So it's a very small, tiny position, kind of introductory, as I do my research into the fixed income market a little bit more. And I just don't know how the economy can sustain 6% yields, but we'll see. Bearish stance toward treasuries in the near to medium term, Hussein says. The outlook arrives as the broader treasury market grapples with signs of weakening global demand. Japan, the largest foreign holder of U.S. sovereign debt, sold a record $61.9 billion of treasuries in the third quarter of 2024. Similarly, China, another major investor, reduced its holdings by $51.3 billion, marking the second largest quarterly sell-off in its history. Hussein also highlighted the growing volatility of treasuries relative to other government bonds, stating that this trend may be driving some investors toward alternative assets. Interesting. That's very interesting. So the safe haven aspect of treasuries is called into question in the sentence. So let's repeat that sentence. Hussein, who is the CIO of Fixed Income at T. Rowe, also highlighted the growing volatility of treasuries relative to other government bonds. What are the government bonds? Stating that this trend may be driving some investors toward alternative assets. Okay, let's see what other government bonds here. Give me 1 second. Oh, I see. Other governments bonds. Okay. German bonds, UK gilts, Japanese government bonds, Canadian government bonds, Australian government bonds. Okay, never mind. I mean, I don't think. Yeah, I'll have to look into that. I'll make a note how the volatility compares for U.S. Treasuries versus this. Okay, let's continue with the article. A bearish view compared to peers. Hussein's outlook stands out as one of the most bearish among leading fixed income strategists. Yeah, interesting. ING Group NV anticipates the 10-year yield could test levels between 5 and 5.5%, while Franklin Templeton and JP Morgan Asset Management see 5% is a reasonable ceiling in 2025. Hussein, however, believes the U.S. economy's resilience makes a recession unlikely, further reducing Treasury's appeal as a safe haven asset. It appears that the Fed has successfully guided the economy into elusive soft landing, Hussein said. The 10-year Treasury yield, a critical benchmark influencing borrowing costs across the economy, has hovered around 4.4% in recent days after reaching a peak of 4.74% earlier this year, which, by the way, again, this article was written mid-December, and we just tested it again today. 4.73, I think, was the max today. Amazing. Traders will closely watch the Federal Reserve's policy statement this week, as the central bank is widely expected to deliver a quarter-point interest rate cut investors will look for further guidance on the Fed's easing trajectory and its stance on inflation. Hussein's forecast suggests that structural inflation drivers combined with worsening US fiscal deficits could keep the Fed cautious despite market expectations for rate cuts. A steeper yield curve, a scenario where long-term yields rise faster than short-term rates, could emerge as a defining feature of the bond market in 2025. This is, by the way, what Jeffrey Gundlach had predicted too. Hussein and his team at T. Rowe Price have a history of accurate calls during challenging market conditions. In 2022, as consensus views underestimate the persistence of inflation, T. Rowe Price Dynamic Global Bond Fund delivered gains, while other funds struggled under the weight of Federal Reserve's aggressive rate hikes. In the same year, Hussein encouraged investors to consider adding bond exposure over the medium term, foreseeing a rise in yields. His current bearish stance reinforces the need for strategic positioning as yields trend higher. If yields do rise to 6%, the impact on the broader financial system would be profound. Higher treasury yields could increase borrowing costs for businesses and households, affecting corporate debt pricing, mortgages, and consumer loans. The US government itself would face higher costs to service its debt, further compounding fiscal challenges. For global investors, the question becomes whether higher yields will be enough to offset concerns around volatility and fiscal stability. Quote, anecdotally, treasuries have become more volatile than other high-quality developed market government bonds, and even some emerging market sovereigns, end quote, Hussein wrote, raising concerns that investors may seek alternatives. Okay. Final thoughts. As 2025 approaches, the treasury market remains at a critical juncture. While 5% yields appear increasingly likely in the short term, T. Rowe forecast for 6% reflects a growing unease about US fiscal policies and inflation risks. For investors, the next several months will be key in determining whether these forecasts materialize and how they will impact financial markets worldwide. The Fed's policy moves, US political developments, and global demand for treasury will all play a pivotal role in shaping this trajectory. A path that could see yields climbing to heights not seen in over 2 decades. And going into this environment with market valuations highest in 2 decades is also problematic, obviously, for stocks. Alphabet asks, where do you disagree with Hussein and why? I don't disagree with him. I think that it's, if like we see how the markets are reacting to 4.7, so imagine what will happen at 5, 5.5, 6 if the yields ever get there. But I don't really disagree with him yet. I think in the near term, as Trump tries to put some, it looks like Trump is going to enact these tariffs. I don't think the markets are. I think a lot of people are kind of looking at his tariff policies and saying, "Oh, this is just negotiation tactic," but it doesn't look like it. So, and it looks like that's going to be the part of the policy that gets implemented first, higher tariffs. So there's going to be some inflation pressures for sure, or from higher tariffs, all else equal. The question is how much inflation pressure would that be? And so that remains to be seen because we don't know the exact policies yet. Palantir down into the 4% today. Micron is down 2%. Couple of the smaller stock semiconductors are down. In the last week, Nvidia is up more than 4%. Micron is up 18%. Palantir down 10%. GM is down 5% in the last week. Interesting. All right, any other news? Let's see. Tesla and Elon today officially filed their appeal with Delaware Supreme Court after a state judge rejected his $56 billion compensation package for the second time. Doesn't look like this appeal is going to work, but the process is moving along. Rivian files patent for heated headlights to tackle winter visibility issues. Okay. Rivian stock had pulled back dramatically in the last 2 days, down from almost $17 per share to $14 per share, just below 14. So that's a 16% drop in just 3 days. And I'm short Rivian. I added to my short above $16 per share. So it's a pretty nice position at this point. I think the company is worthless. I think they're trending to zero, especially with these interest rates now. Tesla Model Y, Sweden's most popular vehicle for second day in a row. Tesla has released a new video of art on the exterior of Giga Berlin factory. Okay. Tesla could collect more than $1 billion in compensation from rival automakers that need help meeting tougher pollution standards in the European Union this year. Okay. I don't think that's going to have any regulatory, unless it gets to 10 billion plus, which doesn't look likely in the near future. Then it would be material, but still, it looks like these credits are going to be either capped or removed. It's just not, part of organic revenue growth or profits. So the markets will always adjust them out. The non-foundation series and foundation series Cyber Beast are now on Tesla's online inventory. So there's some inventory buildup of Cybertruck. Let's look at the Cybertruck resale values. There was one that sold for $75,000 in October 2024. That was the low model watermark. 2024 Tesla Cybertruck all-wheel drive foundation series sold for $75,000 in October. Let's look at CarGurus used Tesla values. Average listing prices for Cybertruck are still about $100,000, down 10% in the last 90 days. Tesla values are declining at about 2x the speed of the average industry in the last 30 days, in the last 90 days, and year over year. Year over year is 3 times as fast. In the last 90 days, Model S, Model X lost about 6% value. Model 3 and Model Y lost about 5% value compared to a CarGurus industry average of 3%. You can't get a reasonable newer model, a later model used vehicle, a Model 3 for less than 20,000. There's thousands of them around. So I think that's pressuring new Model 3 sales. And I think we're going to see the same issue as Model Y, the new Model Y ramps. I think new Model Y is going to ramp throughout 2025, and the decline in used Model Y values, we're going to keep a lid on new Model Y sales for 2025. I expect lower sales in 2025 versus 2024. So 1.8 million sales in 2023, 2024, and 2025. Zero growth in Tesla Automotive, and no free cash flows for automotive. So without FSD take rate increasing materially, which I don't expect anytime soon, the automotive business is challenged. Elon says Neuralink will start trials in the UK this year, as well as potentially Canada, UAE, and New Zealand. Okay. xAI's Grok will be launching Tesla vehicles soon, or we don't know what soon means. It could be years. NKBHD ranks Tesla's currently having the #1 best assisted driving mode after testing Tesla, GM, Ford, Mercedes, and BMW systems. LA is under fire. There are not enough firefighters in LA County to address 4 separate fires of this magnitude. Okay. Not much other news here. Let's see. The markets recovered a little bit. Balance. All markets are flat. Tomorrow, the markets are closed, and on Friday, we're going to get to non-farm payrolls. Average hourly earnings expected to be 0.3%. Unemployment rate expected to be 4.2%. And non-farm payrolls expected to be about 140, 150,000. Down significantly from last month's 200,000 level. So we'll see. ADP employment change was below the expected number on Friday. They don't always correlate, but it's an indication. In about half hour, we're going to FOMC minutes for the last meeting. I'm going to be reading through those minutes. I mean, we can do it here. We can. I'll probably just talk about. If I have a space tomorrow, I'll just talk about tomorrow. If not, we can talk about Friday. But that's going to be potentially a market moving event when the minutes of the last meeting is released with further detail. The concentration in the stock market is even higher than back in the tech bubble. So these are, I mean, clearly, I think a lot of people who I respect agree that markets are overvalued today. People disagree on how much overvalued. Like some people say it's not as overvalued as the internet bubble, but I think it's even more so actually in some respects. Federal Reserve Governor Christopher Waller has expressed a dovish perspective, indicating more interest rate cuts could be on the horizon for 2025. His comments suggest inflation is expected to continue declining towards the Fed's 2% target, although the pace of these cuts will deepen on further inflation data. Waller does not anticipate significant inflation impact from proposed tariffs, highlighting a careful data-driven approach to monetary policy. My bottom line message is that I believe more cuts will be appropriate. On the inflation forecast, Waller is optimistic because 6-month annualized inflation is heading lower. Core was 2.4% in November, better than the 2.8% year-over-year rise. Most of the stickiness in inflation is coming from imputed prices, which is 1/3 of the core price basket, and a less reliable guide to supply-demand imbalances. Base effects could bring the year-over-year inflation reading down by March if the next few months don't pop back up. Well, that's a big if. Waller, minimal further progress on 12-month inflation readings has led to calls to slow or stop reducing the policy rate. However, I believe that inflation will continue to make progress toward our 2% goal over the medium term, and that further reductions will be appropriate. I agree. I mean, I think he's right, and I think it's a policy mistake to keep these rates higher for longer. But I don't set the rates. So. Fed Governor Chris Waller on tariffs. If, as I expect, tariffs do not have a significant personal effect on inflation, they are unlikely to affect my view of appropriate monetary policy. That's a non-statement. As always, the extent of further easing will depend on what the data tells us, etc. Waller's response. to why the long end has moved over 100 basis points higher since the Fed started cutting rates. It wasn't our fault, he said that perhaps markets are thinking inflation won't get down to 2%, but don't worry, Fed will take care of what was his response? I don't know. I mean, I think it's more around the budget deficits more so than inflation concerns, but I guess they're kind of playing to each other. I think this idea that tariffs won't inflate inflation is a little premature. We don't know what the tariffs will be. December, so Stephanie Link posted December Dodge Momentum Index rose 10.2% month over month versus negative 2.3% in November, negative 5.3% in October, and negative 4% December. Commercial rose 14.2%, institutional up 2.5%, led by data center and warehousing. Dodge Momentum Index, I don't know what that is. Dodge Construction Network, okay. In a December 13 column in The Economist, Double Line CEO Jeffrey Gundlach warns that U.S. debt will mushroom beyond the government's ability to service it, in his view, leading to a dollar debasement, debt restructuring, or both. And that's a big call. That's a major call by Jeffrey Gundlach. Neil Dutta, another person I follow. He's not always perfect. None of these people are always perfect, but good, insightful thoughts. Neil Dutta says, a few things on my mind. Housing is simply not working. Mortgage demand is crumbling. For the week ending January 3, mortgage loan applications for purchase sank 6.6%, the fourth decline in the last 5 weeks. The level of conventional purchase applications hit its lowest since 2011, and the 30-year fixed rate mortgage is back to 7%. Labor markets keep cooling. There's more signal from the quits rate than openings, and the private sector quits rate hit a fresh cycle low, which implies cooling wage growth through the middle of this year. Rates have been rising as nominal growth has cooled. S&P Global's monthly US NGDP series has slowed recently. Over the 3 months ending in November, up just 2.9% annualized and 3.5% on a 3-month to 3-month basis. If the rate of government debt is higher than nominal growth, debt continues to rise. Something to keep in mind as DC embarks on a mission of doing stuff. Perhaps there are more constraints than they appreciate. Exactly, that's my view as well. I think I don't think the Trump administration is gonna be able to do even half the stuff they said they're gonna do, but we'll see. The rate increase is global in nature. We're seeing long-term rates rising in the UK, Germany, Japan. Because the US is a stronger economy, it can cope with higher rates better than others. Productivity growth is weak in the UK, particularly after Brexit. The US is an energy producer while Europe is a big importer. Germany is also in bad shape due to loss of competitiveness as China supplants their auto industry. Japan has been chronically weak. This morning, we saw Waller on the tapes. He was dovish in the sense that he sees still slowing inflation, additional rate cuts. He also said, if, as I expect, tariffs do not have a significant personal effect on inflation, they are unlikely to affect my view on appropriate monetary policy. Sounds like someone wants to be Fed chair next year. Yeah. This is a view that was that Waller saying these things because his positioning for a replacement for Powell under Trump is this is the second time I've seen this today. I don't know. We'll see. Yeah. Here's a view that we talked about yesterday about Microsoft's investment into $80 billion figure that's been thrown around headlines. The AI digestion phase seems to be here for Microsoft. That's exactly my view as well. On January 3rd, Microsoft posted in a blog expectation of $80 billion in capex in fiscal year 2025 to support AI and cloud. While up 44% versus fiscal year 2024, it implies slightly negative growth H1 calendar year 25 versus second half of calendar year 2024, given $20 billion in Q3 and guidance of an increase in Q4. But this is good for their own future cash flow and ROI, which suffered last year. This contributed to stock being up just 12% versus S&P gain of 23% in 2024. Suppliers to Microsoft, which benefited last year, should see headwinds this year. Like Nvidia. Nvidia is the biggest supplier to Microsoft, and that's exactly what it's talking about, and that's why I'm short Nvidia stock. Great. Anything else? Anything else? Steven Yutzi showing the 5%. Are you here, Steven? Yeah, he bet on that. We have a coffee bet that we're gonna see 5 handle. He said we will a year ago. I said no way, but we're close. Jim Bianco posted that today the 5 largest stocks in the S&P 500 comprise 29% of the market value, higher in history, highest in history. Even in 1964, which was the second highest, you had 27.6%. And the third highest would be 24.9% in 1969. In the 1999 bubble, it went to 16.6%. So never in history, top 5 companies have comprised this much of the market value. There's tremendous concentration. And I think all of these top 5 companies are challenged in terms of their valuations. Apple, Nvidia, Microsoft, Amazon, Alphabet. I will not be investing in Mag 7 companies today. Housing builders spec inventory is exploding in 2024. I wouldn't use the word exploding, but it's the highest ever except for the housing bubble. Spec inventory, new homes for sale, completed homes, was higher in 2007 and 2008 and 2009. Except for that 3-year period, we are at the highest level today. So that shows there's ample supply in the housing market, despite what we're told by realtors. But that's given the background of a backdrop of 7%, 8% mortgage rates. So nobody really knows what will happen to demand at 5% today. Any other questions, comments? Questions, comments? Let's see YouTube. Otherwise, we're going to end the space. Amy, thank you very much for the like on YouTube. Highly appreciated. Let me see. We talked about the economic calendar. Markets are choppy today. Not much news. Tomorrow they're closed. So it's going to be, and it's very cold. The other thing is, it's been a very cold winter so far. And so this add another reason why Tesla sales will be challenging in Q1. People don't go around shopping in the winter. And or car sales in general. I guess Tesla, because it's selling online, you may have a slight benefit, but usually cold weather means lower spending across the economy. I'm adding to my shorts on Carvana, Nvidia, Tesla, Rivian, and I guess Rivian came down a lot, so I probably hold off on that a little bit because I had a lot above 16. But the other one's Axon, which is up 2% today after the upgrade. The stock sank from $600 to $550 per share, and now back up to about $572. So if it goes back up to 600, maybe I'll add some more. But that's another stock that's super overvalued, I think. No earnings to speak of, and $50 billion valuation, and some AI hype. Palantir is down about 15% in 3 days. That's another short, but I'm not adding to Palantir at this point. Steven?
Hey, man, just a question about the short that you took up in Tesla, or that you still have. Now, when you open that position, sir, do you consider the political, or do you consider, things outside of the market that could impact the price, like, Elon just going further to the right or something that may cause it to go up without an explanation? I mean, are you considering that at all as a possibility, or?
Yeah, absolutely. I mean, that's definitely one of the main pillars, is that the CEO is spending more time on politics than Tesla, it appears, at least, and global politics. And he's getting a lot of pushback on, and I'm all for people's free speech. I think what he's doing with X is very important for the country and the world, but it has implications for Tesla demand. So there are millions of people out there who will never buy a Tesla because of recent actions. And I would say tens of millions of people who will not, who will choose to buy something else in the near term. So this is like, if you consider the fact that Europeans are as left, if not more left, than California, that explains part of the weakness in European sales, I think. And this will also apply to Powerwall sales, or solar roof sales, or I mean solar panel sales, or Optimus in the future, FSD subscriptions, etc. So
So I have one other question, sir. I'm sorry to come off mute.
you don't
Just
have
to
to call me
follow up.
sir. Why you call me sir?
Sorry, just trying to ease the tension. But so you know what? It escaped me now. Jesus, I apologize.
That's okay. Carvana is flat, is choppy around $199 per share after dropping to below 180, 175 or so. Amazing. Yeah, just ask whenever you remember, Steven.
I got it. So when's the next indicator that we're going to have of overall growth or lack thereof for Tesla? When's the next? Is it going to be when they report their earnings again, or?
I would subscribe to Troy's Patreon. That's probably the best source for this kind of stuff.
Okay, thanks, sir.
I mean, we're just gonna get from Tesla, we're just gonna get management statements, which obviously are biased, like any other management statement. So I wouldn't rely on those too much. And I guess there's gonna be a new Model Y coming, just like the new Model 3. But new Model 3 sales have been challenged. One, because interest rates are still high, and two, because the resale values of used Model 3s have dropped so substantially that a lot of people would just buy used Model 3s at half the price. Just a couple-year-old used Model 3s at half the price is limiting new Model 3 sales. And I think the same will happen with the Model Y sales. So um, I think we're going to see the same with Model Y. New Model Y, as it ramps throughout 2025, it's going to take a year to ramp the new Model Y to volume production, just like any other production ramp in Tesla's history. And old Model Y values, like you're going to be able to buy a used Model Y for less than $20,000 with reasonable miles a year from today. So at that point, people will be choosing between a $20,000 couple-year-old Model Y versus a $40,000 new Model Y. And maybe the EV tax credit isn't going to be there. There's also some concerns around CATL batteries being imported into the US. Panasonic is trying to ramp up their own production, but that's going to take years. It's not going to be as low cost as CATL batteries. And there's going to be some countermeasures from the Chinese government if Trump does increase tariffs, or this protectionism around the world is going to be inflationary and a headwind to growth. And like I said, Trump is coming to a complete different environment today, economic macro backdrop, than he did in 2016, but with the same playbook. So, I think it's a dangerous proposition. Magic,
Hey, how's it going?
good over here.
Good, man. Yeah, no, I agree. I think, dude, like, focusing on macros extremely important right now. I wouldn't touch any auto company. I think you're seeing trouble. Nissan's already merging with, Honda. You have Dodge, Chrysler, whatever. Stellantis group is having issues. So there's a lot of, maybe there was some oversupply, and those car companies are typically very, very weak. Those are the ones that pretty much I agree they should. Nissan and Chrysler should never make a car ever again. I think that's a net positive for society. But yeah, I think you're seeing that the consumers is stretched. So the interest rates are gonna keep going higher. or at least hold for a bit. I don't see much rate cuts, and until we get a clear picture on inflation. So it's going to be more expensive to finance a car, and that's usually what deters people from doing it. So this is not just Tesla. I think just in general, the car market is not a great place to be.
I agree.
What about pharmaceuticals, gentlemen? If anyone has an opinion, like Moderna, does anyone
No,
think
it's not my area of expertise. I actually applied for an investment job back in like with a team that is like an extremely good track record, which is a really difficult job to get. It's a long-term investment type of team. And the the CIO of that team, or the portfolio manager of that team, is like well known. And I was on a one-on-one interview with him, and he said the one question, I remember the exact questions he asked to this day. It was a while ago. He asked, if you could, if you like, if I asked you which sector you definitely don't want to cover, which one would you say? And my answer was healthcare, because I think you need some really deep expertise in that sector um, to be competitive on the investment front. So I can't answer your question about Moderna. Ryan?
Hey, man. Last couple of weeks, it seems like you've been pretty confident or increasing your probability of a US recession. I was just curious to hear your rationale for that.
I think the job market is weakening faster than people realize, and it's continuing to weaken. The only data points that the data point that's kind of goes against that, though, what I just said, is the initial weekly claims have been low at 200,000. That's still very low, but job creation is also very low. So to the extent that somebody does get laid off, they can't find a job today. It takes about 9 to 10 weeks to find a job today, again, on average. And that's because companies aren't hire. And today we got the ADP numbers lower than expected at only 122,000, which is lower than what you need to sustain the growth, to keep the unemployment rate at 4.2%. So I think the unemployment rate will continue to increase. And I think the stock market will, stock market drop will precede that. I would expect a 20% drop in the stock market in the near future. So I think the strength in the stock market, people are kind of conflating that with the strength in the underlying economy. But that strength in the stock market is coming from a handful of companies, primarily semiconductor and primarily Nvidia. And I mean, how many people Nvidia will hire? A lot of these small cap companies who have employ about 1/3 of the people in the US, they don't have profits. They're facing these debt walls that are going to reset at much higher interest rates. So I don't really see them hiring either. And if they don't hire, then how is the spending in the economy going to grow? So I think the pressure on the economy today is greater than people realize. So yeah.
Yaman, how long do you have in finance overall?
In finance, I mean, I started trading stocks at age 15, and I turned 40 today. So,
Okay, yeah, that's pretty long fucking time.
but I'm an econ major in college. I studied finance and econ double major. I have an accounting master's from UVA, and and I'm a CPA, CFA, both inactive, and I worked for an investment management company for a few years, mid office, like M&A, doing M&A, acquiring other investment management companies. And then I was an investment banker before that for a few years. And then I worked for public and private accounting before that. And I've been investing on my own since 2016. So, coming up to 10 years almost. So,
Thanks. No, I was just curious. I don't think I ever asked you, or you never said exactly how long you've been in doing this stuff.
yeah. made a lot of mistakes along the way. I mean, most recently, interest rates. I didn't see these interest rates coming up this high, staying up this high for a long time, and that was part of the reason why and that was the primary reason why I missed the whole Tesla was triple in 2022 call. And had I known that, I actually saw that as a risk, and I talked to some bond managers about how high the 10-year yield could go, and I was told, I kind of outsourced the expertise, and I was told that they wouldn't go higher than 2.3%. So that obviously proved wrong. And that's exactly the question. Like, that's exactly what I thought. Like, so it wasn't an unknown that got me. It was a known unknown, I guess. And I shouldn't have outsourced it to somebody who I thought was, and this person has just tremendous experience in bonds, you know, and they got it wrong. And so I invested the last 2 years into teaching myself this, this, that variable, learning more about that variable.
Yeah, no, Jim, I had a similar experience. I talked to very, very large fixed income managers, and they all told me that, the 10-year wasn't going to go above that. I didn't necessarily believe them because the big thing is that everybody talks their book, right? So it'd be hugely disadvantageous for them if the 10-year did go above that, right? Because they're investing in fixed income. So
No, this person didn't have the incentive structure to,
Mhm.
and also I know this person personally too. So it wasn't that. I think they were just as blindsided as I was.
No, I mean the whole industry was. I mean, you're telling me a
Yeah,
lot of people bought the 10-year, right? Like you're telling me PIMCO was on the offsides on the 10-year, right? Like not they a lot of people did believe the Fed and they did believe the data and like they went with it. And like
right.
so it's not like I'm not telling you that he was bad or I'm just saying the industry like there are things like the industry you're gonna say like, okay, I mean if they say that the 10 years gonna go to 5%, they're gonna, all the bond like the bond managers are not gonna be able to, get that money. I think they did it with the good interest, and I think they did the calculations, but they didn't understand how much money they were going to print and how hot they were going to let this run. So,
Yeah, exactly. And then I had to kind of, just get my confirmation bias and like reduce it a little bit as much as I can. I mean, I still suffer from it to this day, but um, like today I was in a conversation and I noticed that I'm like looking for evidence that disproves what I'm thinking as I'm thinking it, in response to a question I was asked. So I was like, okay, that's progress. That's good. Any other questions, comments? Ryan, what's your background?
I'm a data scientist at an ecom company, uh, master's degree in data science, and another one in operations research engineering.
Okay, so what do you expect? What kind of what kind of econ data do you analyze?
I don't do a ton. I mostly just listen to talking heads and try to form opinions based on that. But I am curious about it seems like the 10-year yield is up because the market's anticipating high inflation from Trump's tariffs. But we also know Trump is like a poker player. I don't think he's realistically going to try to impose 60% tariffs on Chinese imports. So, um, not really sure how to play that, but I, I'm not sure I buy the yield being this high for this long.
Yeah, give me 1 second. So no, wait, where am I? Hold on 1 second. Can you guys hear me?
Yep.
Okay. So I think how inflationary tariffs are going to be is TBD. Like they're definitely going to be inflationary, but how much is TBD? But what is not TBD is that we have a massive budget deficit versus GDP. So that's like a record level, especially for not recession times. So what happens if you have a recession? You can't really grow the deficit further without massive consequences. and any sort of any sort of um, you know efforts from Doge, Department of Government Efficiency, will take a long time. So um, that's not going to happen day one. It's not going to happen in the first year either. And a lot of people are skeptical that it will ever happen. But the budget deficit is today. So that's inflationary, and that's an issue for the 10-year yields. And then another big issue right now is, Ryan, is that um, during Yellen's tenure, the Treasury financed the government deficit with short-term Treasury bills. So meaning maturities 1 year or less. And they need to be refied, just like corporations need to refi their debt, roll them over. The government has to do the same thing. And are they going to lock in high interest rates by issuing 5, 10, 20, 30-year bonds? They're at 5% today almost. I mean, 30 years almost 5%. So by the way, we just got the Fed minutes. Here's a few headlines by Walter Bloomberg. Okay. Many saw a need for a careful approach in coming quarters. FOMC minutes. Trade policy could make inflation data harder to read. FOMC minutes. Some officials saw merit in holding rates steady in December, which is amazing. I mean, that statement is pretty, like, it was a very close call. One of the biggest comments that Powell made in the presser after the meeting was that it was a close call, because the probability that was estimated for a pause going into the meeting was about 2-3%. Almost all officials said upside risks to inflation had increased. So that's a new one too. That almost all committee members say upside to inflation risks have increased. Let's look at this 2-year yields while we read this right now. It's been 3 minutes since these minutes were released. Wow. 4.29%. So not much of a change so far in the 2-year yield. And we're now also seeing major movements in the stock markets so far. The stocks are turning down a little bit, but that's about it. Fed officials, the breaking headline from CNBC is Fed officials are worried about the inflation impacts from Trump's policies, minutes show. Okay, I mean, we did get that a little bit in the press release, so that's not new information. Officials expected slower progress on inflation due to Trump's trade immigration plans. Officials expected to slow pace of rate cuts after December meeting. Yeah. Okay, so these are pretty much in line with what we'd expect to see from the minutes if you had listened to the press conference. So nothing new here so far. Kevin King says bond forecasters are rarely get the direction right, let alone the magnitude of any changes. Yeah, that's like saying an average stock investor. But there's a wide range of abilities in bond investors as well as stock investors. So doesn't really say much there. All right. Let's look at Tesla stock. Flat. Nvidia stock. Flat. Very low volatility today. All right. Any other questions, comments? Hey, Magic. What do you think was the cost of Tesla's 0% financing? What one-time payments do you think Tesla made to the financier to offer that 0% APR?
Yeah, it's a good question. I think obviously it depends on their credit score, and assuming, let's say they have a good credit
Assume
score.
700.
Okay, yeah, I mean, and assuming a purchase price of about 40,000, I think I calculated around $4,000 to $6,000, depending on how you look
Yeah.
at that. So
Yeah,
that
40,000. So 40,000 purchase price. Are you assuming down payment?
Well, again, if you finance the whole thing, I mean, you have to make some assumptions here just to get a round number.
Right.
I'm just saying you finance the whole thing. I mean, if you want a down payment, you'd have to bring it down a bit, obviously, because you're not financing that full amount. But
Yeah.
assuming it's a good credit score, and obviously the worse the credit score, the more they subsidize, right? Because instead of
Right.
getting 12%, they're going to get a 0%. So assuming that these are very customers with pretty good credit, it's still like 3,000-4,000 per car. I would say minimum, like that. Them taking that.
Yeah, I mean, I was assuming a 40,000 long balance, not 40,000 car price. So assuming 40,000 long balance with a for a Model Y in the US, you're looking at more like $68,000 per car, I think.
Yeah, I mean, it's correct. Like the loan balance is 40,000. So I mean, whatever the fees, whatever down payment, like
Right.
just about a round number, just to get to kind of approximately what that would be in terms of. It's pretty
Do you
substantial.
agree with the following? Do we agree with the following statement? Tesla's Q4 automotive non-GAAP margins will be lower than Q3.
I do believe so, but again, last quarter was very strange how gross margins went up. So
Did you see Troy's message on that?
I didn't.
So Troy posted about Cybertruck, and we discussed this in yesterday's space. This is what happens when you miss a space. We talked about how in Q3, Tesla delivered a lot more Cyber Beast than in Q1, Q2, or Q4. So Troy speculates and says Tesla wanted to say that Cybertruck is gross margin positive, and therefore they held back on delivering Cyber Beast in Q2 and delivered them all in Q3. Here, I'll pin it at the top here.
Okay. Yeah, I mean that makes sense. Yeah, whatever they did, it didn't seem logical. So I mean, I would definitely agree that Q4 margins are going to be affected here. So
yeah, and then how many deliveries do you expect in Q1?
I think what was it, like 390 or something? They were saying. I don't know. I don't know the exact number, but probably lower than what Wall Street estimates right now.
Yeah, I made a bet with one of the people, and I said less than 420, and he took the over on that one. Actually, I think we bet 450. Let me see. So I pinned Troy's tweet at the top, so you can read that while I look for this. This is the Cybertruck margins. The bet I had with this person was for 455,000 with Tesla Fanatico.
All right. Yeah, that's a joke. There's no way they're hitting that.
Yeah, well, this guy has been correct on things, so I'm a little surprised that he took the over on that one. Honestly, he was a little aggressive.
I mean, yeah. If you understand interest rates and how bad 70% of GDP is consumer spending, and if you look at the ground, people are not getting hired, people are not spending as much. I mean, if you want to just extrapolate based on previous quarters, that's fine, but there's a completely different consumer situation right now.
Yeah. What did you think of the tweet at the top?
I mean, it makes sense. I'm just kind of reading through it, but I'm like, I mean, that can be, yeah. I mean, if this is the case that they did, push it in Q3, then I can see that being the case. But yeah, I think just going forward, first of all, this is going to be audited, so I don't know if things can be moved around as easily as they were in other quarters. So, but yeah, I think gross
What do you
margins.
mean? What do you mean audited?
I mean, the Q4 is audited, right? I mean, Q1, 2, 3 are just reviewed. So
This has nothing to do with an audit. Management can do this. They can hold back on Cyber Beast and put in Q3. There's nothing
no,
auditor can say.
what I'm saying is that I'm hinting that some of the accounting in the other quarters are, let's just say, creative in certain things. That's my assumption. Okay, that's fine. I'm not telling you to agree. I'm just saying that. So from my standpoint, I'm like that does factor in. Like, okay, the gross margins should theoretically be lower. I don't see any. They're discounting. Like, what are they doing? They're discounting. They're trying to move metal. They're doing everything, offering free supercharger miles, doing this 0%, extended discounts. I mean, that's not if you didn't have to do that, you wouldn't do that. Like, that's just common sense. So the fact that the incentives remain and that they keep doing these heavy incentives is hinting to me that there's more supply than demand, or they're trying to match that supply and demand, and there's oversupply.
Yeah, I agree. All right, Anything else? Ryan, Steven, or anybody in the audience or on YouTube? Going once, going twice. All right, let's call it a day. Thank you very much, everybody. And I will chat with you all tomorrow. Maybe tomorrow, probably Friday. Take care.